Welcome to our update. Today is Friday, May the 15th. Interesting week on the market. Wanted to do Friday wrap-up relative to what we saw on the week, what we kind of look at going into the next week based on the current environment that we're in. So to kind of set the landscape of where we stand right now, one of the things that is taking place is that you still have a weak fundamental environment versus a technical environment that's breaking out. So on the fundamental side, when you look at earnings or you look at any of the economic data and sundry other components, I don't think you have anything trending to the upside that I've seen of late. You had a lot of sideways movement. You had some weak sales reports this week. It's really not been the kind of fundamental environment that you'd want to embrace by any stretch of the imagination, at least from a shorter-term perspective. Where on the technical side, you have things that have been consolidating, and on Thursday you had the S&P 500 break to a new high. But all of that as it may be, you still have this center component, which is what I would deem to be a combined outside market event and inside market event, which is the fact that you've got interest rates acting on the markets over the last couple of weeks, which we'll look at. And that's created some uncertainty and a little bit of unsettlement in the market, at least up until Thursday. And we'll look at what our focus is in and around that and see how that unfolds as well. But there'll be a lot of interesting movement going forward as to whether or not this market can actually find the volume, find the buyers that are willing to take it higher or not. So we'll kind of break it down and look at the different parts as we go through it. As far as, let's just start with the S&P 500 since it attempted there, as you can see on Thursday's bar right there, a new high on a closing basis. And then at the time of this recording, we're basically where we closed on Thursday, almost flat on the day. Friday, very little activity, volume kind of anemic on Friday. A little bit of selling early, at very little, I guess, would be the best way to put it. But the markets are going to close essentially in a positive vein for the week, but it didn't really start out that way, which you can see this bar, the big green bar right here is last Friday's close, that bar right there. And then we start out the week with 2 down days, a third day that didn't pan out all that great on Wednesday with an up day start and sold off. And then Thursday we get the big move back to the new high, and then we hold that into Friday. And so when all's said and done, we're going to end the week essentially up 0.25% on the S&P 500, which is nothing dramatic, nor is the breakout that dramatic, but the headlines would have us believe that we're headed to 3,000 on the S&P going into next week, which I don't think that is true either at this stage. So I'm going to stick with the fact that I've written all week and that we've talked about over the last 3 weeks, that this market is still in a stage of uncertainty, and that's being driven by my previous comments. The fundamentals can't support the technicals, and then you've got a sundry other news events going on where you've got a weaker dollar, stronger commodities, you got uncertainty in oil commodities, to say the least. And then globally, you've got a lot of issues around Europe. You've still got the issue with Greece and debt there. Russia has recovered a little bit because of oil prices creeping higher. Asia has got problems. China's got problems. The emerging markets are unsettled because we don't know which way the dollar is going to go. And so you've got a lot of just swirling in the marketplaces that creates a lot of uncertainty to the market. So I can go through all of that because I'm going to come back to what I believe about markets like this is that you really have to step back and understand what strategy or approach you're going to take with these type of environments. Because, traditional what we may use in a pattern type environment, or what we may use in a momentum type environment, or a decelerating environment, those markets have distinct strategies that work within them. When you get into choppy markets, none of those tend to work very well, and that's why they're called choppy, as they chop around and different strategies struggle. And it creates anxiety, it creates bad trading habits, it creates a lot of issues relative to money management, and those are the things that you have to be cognizant of on a day-to-day basis in this market environment. And I have talked about this many times in the past, that when we get into these types of environments, one of the things that we look at when you've got something that looks like this, consolidation and chop, is that we'll cut our position size in half. So we downsize how much we take so that when we look at the stops, we can use wider stops on our positions, which allow us to let some of this chop work its way out. So we gap the stops out, half size the positions, and then manage our risk accordingly. So by having wider stops and half the dollar commitment, where we end up with is the same dollar risk on each position. So example would be, if I were to buy this breakout and my stop would be here normally, I may have my stop down here. So I almost double the size of the stop, but I only have half of a position working, so my actual dollar at risk is the same amount to my overall portfolio, and that's managing the environment. So it's allowing me to use strategies that fit within my risk tolerance by dollar amounts and not percent amounts. I think percent amounts sometimes get us off of track by looking at that it's the true dollar impact that we're looking at. Yes, the percentage of risk rises, but the actual true dollar impact is the same because we use less size in the portfolio. So when it's all said and done, we end up, in a much better mental state for managing money than beating our head against the wall. And I think that's as important as anything else if you're going to expose money in this type of an environment. An example would be about 3 or 4 weeks ago, we actually added on this bottom reversal right here, and we added on the SPY, we added this position at 204.50, and we still own that position today. But if we had raised our stop, say, to 206 or 207, when we got up in here at 211, 212 just a couple of weeks ago, if we had gone up, had our stops up in here, we would have been stopped out of the position, and it's back at 212 again, but we were able to stay in that position because of that and by using the wider stop. So as we break out here and hopefully continue to move to the upside on that long position, we can hold that position and feel more comfortable because our dollar exposure as far as risk is the same as if it were a more intricate environment or trending environment that we feel more comfortable in raising our stops. So put into practice things that work for you within the different cycles. So I wanted to address that first and foremost. And then, where do we see the S&P going from here? I think it's really a matter of leadership. We still don't really have, at least in my mind, we don't have true leadership relative to what's going on. And if we look at the S&P 500 and we go back to our pivot point, and we're using this March 11th low as our current pivot point, you could actually even go back to the February point as well. But you can see that we wrote earlier in the week that we only had one, which was energy, and I wouldn't really say that of late, that energy is outperforming the index. It's just going back to the pivot point it has. Now we have three with tech back above it and healthcare, along with energy above the index itself, but the others are still trailing below it, meaning we don't really have any true defined leadership in this market. And even if we came forward, let's just use if we look at this low right here on the 6th of May and we roll that forward and look at the 6th of May as a pivot point, you can see that it really doesn't change a whole lot. Everything's, aggregating around the mean, which is the index itself. So how do we account for that? Well, you really can't. You just have to let the markets adjust until that leadership gets defined. And until we do have some definitive leadership in this market, I think that you're going to continue to chop around, because something has to take on a leadership role that will give investors confidence on a forward-looking basis. And that's the component right now that's missing, is that forward-looking confidence relative to the indexes themselves as to how we can make money, at least looking forward. So that, to me, is very important as we go forward, that we kind of put all of that into perspective so that we can kind of invest without feeling like we're missing something. That becomes a big issue for investors. They always feel like that something is going haywire. We're going to miss out on the opportunity on the upside, blah, blah, blah. Let the markets define themselves. I'm more willing, I believe, as I've matured as an investor, to, always understand and believe that I can make up for lost opportunities and or missed opportunities, but making up for, losses is much harder to do, at least from my perspective, on a forward-looking basis. So we have a couple of pivot points that we could use equally here. You got the March 11th, and then we have this April 18th time frame. So let's look at these on the NASDAQ. This is the QQQ. So we'll look at what's transpiring as far as the top. I have this benchmarked against the top 10 stocks within the NASDAQ, and looking for what is leading or not. And these are by size. There's no magic to them, but it gives you a pretty good mixture of what's going on. And you can see relative to that you've got Amazon on the upside. Microsoft has had a nice run. Vodafone, and you can see Gilead of late has started to move back to the upside. So you do have some leadership within the NASDAQ. And you can also see here, by stretching it back to the April 18th timeline, even more clearly the Microsoft and Amazon leadership relative to what's happening right now. And if we wanted to, I just want to go in here and edit this real quick. If we take Chevron out of here just for argument's sake at this point, I want to look at Netflix, just because it's been one of the better components inside of what's happening of late. But you can see yellow that Netflix was a laggard in here, but you can see off of this May 4th low that it has started to accelerate, and now it's accelerated above the NASDAQ, adding to some leadership within there. So bottom line is you're seeing a little bit of leadership in the NASDAQ, but even that, I think, has been very sparse at best relative to the overall outlook for the index itself. In fact, if we go back over and look at the Qs here on the NASDAQ 100, you can see that the choppiness has been just as apparent in here, moving around. We did get back above the 109 level on the Qs, which puts us back in an upward, trekking momentum, and we'll see if that can follow through as well. And then you have the Dow, which has been trying to break out to a new high as well. A little bit of a doji on that. If we had a candlestick on there today, you can see that we got kind of a doji day for really the markets overall. And that'll be interesting going into Monday as to whether that's a doji for a trend reversal that continues, or a trend that continues higher, trend continuation, or a trend reversal. But again, you got to let things happen or fall out as they will. But the concern here with the Dow has been with the transports, which have been weaker. They have not actually put any, the previous highs are up here. We've been trading down in here, and if anything, we have kind of a head and shoulder pattern that started to break here on Wednesday. Now we've bounced back off of that, but we'll see how this chop plays out with the transports versus the Dow. The theory is that the transports, if they lag the Dow, that's generally not a positive sign, at least on a forward-looking basis, theoretically, and we'll see if that folds out to be true or not as well. So the major indexes really have not been all that great from my perspective. Small caps have been lagging as well. You can see that they've stayed below that 123.75 level of resistance after breaking. They've broken the uptrend line off the October low. We've stayed below that. We're below the 50-day moving average. So the small caps have really been the weaker link of the major indexes, and that's something also that will be important going into next week, how that unfolds as well. And as you break down the sectors as a whole, we're just not seeing a whole lot of leadership in any way, shape, or form. In fact, if we go over here and let's just look at a couple of scans that we run on a regular basis. But you can see that if we look down here, we're looking at the scans for the basic ETF scan. You can look at the YNN, which is the China 3 times bull. FXI would be the unleveraged version. But you can see this mess that we've got in here. And the regression line, this is a 30-day regression line, is flat, meaning that I would like to see if we can move back above that regression line and back up towards the highs. That would be of interest to me on the upside. You can see the leadership really has been unique. Russia, nice move again today. We pulled back yesterday, but nice follow through. That trend, that regression line is very positive on the upside. Brazil is one that we've also been watching, and you can see some of the consolidation right in here with Brazil. And if this consolidation breaks out, then you've got a double bottom with kind of a flag or pennant pattern, and a continuation there would take it back up maybe in the 950, 975 range on Brazil, which would be a significant move. So I wouldn't count them out of the picture either. Hong Kong, you can see nice movement in there. Silver has been another one that broke out of this bottom consolidation, broke the downtrend, gapped higher, bumping against a little bit of resistance. But I kind of like really what we're seeing in silver and gold at this point. You can see Poland has been very positive. Utilities get a little bit of a bump today off of their lows. But, just flipping through this scan quickly, this is running real time. We can see junior gold miners. Gold miners have been moving. Natural gas has been moving. That's been actually a very good positive, really, over the last week and a half. Gold started moving this week again. A lot of speculation around what we're seeing there. Global real estate coming off of its lows. It's still in a downtrend, but you can see that base or bottoming pattern, and we managed to move back above the 50-day moving average on that. But you can see there are some positives in the market, but it tends to be very favored right now to the commodities and to the global markets. It's much less favored to the U.S. Matter of fact, if we go through the scan, we'd have to go a ways down before we start to find things like Cure, which is healthcare. But even that, even though you see these positive scans relative to what we're seeing here, but you can see this is set up kind of in a downtrending or a descending triangle, which is not, positive unless we can break above that with some confidence and maybe get above that 158 level. But healthcare has struggled across the board. But so when we scan through the U.S. sectors, you can see the biotechs there have not done well. The semiconductors, this is setting up possibly to move back to the upside, and that would be at least some positive from my perspective. And you see this trading range that we've been in. If we can get above that 96.50-ish level, we got above 95. Now we need to take out these highs right here and maybe trade back up to these highs and beyond that if we can get some leadership back into the semis. And, we've bounced in the internet space has struggled as well. We bounced FDN, which is internet, bounced this week a little bit. You can see, that's wrong symbol, SOCL. The social media stocks bounced a little bit. Nice bounce in Facebook yesterday. But you're seeing that the leader really in the tech space has been software, which we've written about, pull back on the breakout from yesterday, but we're holding above that 101.15-ish level on the breakout today. A little bit of consolidation there, but that's been the leader. The networking stocks are trying to break higher as well, a little bit of a cup and handle pattern on that. But I like what we're seeing within tech. Maybe it can take on some of that leadership. If you look at XLK, it just needs to break above that. Financials, we're trying on the higher rates, but that has not folded out as well either. But again, just a lot of mess in the market. A lot of things are looking positive, but they haven't followed through on the upside, and that's one of the things that we do want to see. Now, if we look at interest rates, this will be the last thing we talk about going into next week. And I've kind of bantered this around all week because this is something that, for me, it's been important because you don't want to. You can see this consolidation low here. I mean, rates came off this low over here, come up, we come back and we consolidate, and then we break up. But you can see that when the rate of ascent in interest rates is significant, the market gets uncomfortable, and that's where you will see the markets chop around or sell off, is based on the ascent rate of yields. And you can see that we ascended very quickly again. I mean, you can see these are very similar in nature, and we could probably come back into this range and test, which we did on Friday. As you can see here, we were down 10 basis points on the 10-year. That's a big move for the 10-year on the downside. I would look at support around the 2.1 even on that. We're at 2.14 on the yield right now. So maybe another 4 or 5 basis points off this downside movement, and then catch some consolidation. But we talked about Monday, Tuesday, and Wednesday. Watch out, because it's the acceleration and all the ramblings about interest rates. The market will take it. The traders are going to take it as far as they can. The investors will ultimately even it out as the fast money dissipates and moves away. So the 10-year came back, and then TYX, which is the 30-year yield, we can see 14 basis point move on the 30-year Treasury, back below 3 at 292. And again, I think you get back into this consolidation range down here around 284. That brings the 200-day moving average back into play, but watch for this to consolidate. It's the rate of ascent that's bothering everybody, and that's going to come back and consolidate, and that could be the boost that the market wants or needs on a forward-looking basis. So I think you got a lot of issues on the table. It is a very trying market environment. It's not one that I truly treasure being involved in at this juncture. We have holdings. We've traded stuff. We've taken money off the table through stops. And we'll continue to hold cash and do the things that will preserve capital, but I'm not going to stick my head out and get it cut off just because I want to trade. Let the market come to you. Don't chase it, because if you're chasing it in these 2 and 3 day cycles, you're only going to make yourself get a headache by banging your head against the wall. So take it for what it is. Focus, be disciplined, play some golf, travel, do some things other than beat your head against the wall. So with that, we'll leave it there, and we'll see you next week.